Imagine a battlefield where the weapons are differential equations, the soldiers hold PhDs in physics, and victory is measured in microseconds. This isn't a university lab, it's modern Wall Street. In the 1980s, a small group of mathematicians and physicists invaded the financial district, armed with equations that would permanently dismantle the old financial order. The invasion began quietly. Wall Street's traditional trading floors, dominated by relationships and gut instincts, suddenly saw an influx of rocket scientists from places like Bell Labs and NASA. These physicists and mathematicians saw market patterns where others saw chaos. They brought with them sophisticated models that could price complexity itself. The revolution found its Bible in the Black-Scholes equation. Developed by Fisher-Black, Myron Scholes, and Robert Merton, this seemingly simple formula solved the centuries-old problem of how to price stock options. By 1973, their model was published and quickly adopted, creating the modern derivatives market. Scholes and Merton would later receive the Nobel Prize in Economics for their work. But the true masters of this new world emerged in secrecy. Renaissance Technologies, founded by former code breaker Jim Simons, assembled perhaps the greatest concentration of mathematical talent ever seen in finance. Their medallion fund achieved returns that seemed impossible, averaging over 66% annually before fees for 3 decades, turning $1,000 into millions while traditional investors watched in disbelief. The battlefield shifted from days to milliseconds with the rise of high-frequency trading. By the 2000s, firms were spending billions on microwave networks and fiber optics to shave microseconds off trade execution times. Algorithms now execute trades in 0.00000001 seconds, so fast that being physically closer to exchange servers became worth millions in profits. This sparked an endless mathematical arms race. What began with simple statistical arbitrage evolved into machine learning systems that analyze thousands of data streams simultaneously. Today's quant firms employ neural networks that detect patterns no human could ever perceive, analyzing everything from satellite images of parking lots to sentiment in earnings call transcripts. The quants didn't just revolutionize trading, they transformed how we understand risk. Value-at-risk models, developed by J.P. Morgan in the 1990s, gave institutions a mathematical framework for measuring potential losses. Suddenly, risk management became a quantitative discipline, though these very models would later be tested during the 2008 financial crisis. The human cost was immense. Trading pits that once roared with hundreds of shouting traders fell silent. An estimated 50,000 traditional trading jobs disappeared between 2000 and 2020 alone. The old guard, traders who relied on intuition and relationships, found themselves competing against algorithms that never slept and never doubted. Now we stand at the next frontier. Artificial intelligence and deep learning are pushing quantitative finance into uncharted territory. Firms are developing AI that can teach itself trading strategies through reinforcement learning, creating systems so complex that even their designers don't fully understand their decision-making processes. The quantitative revolution has permanently altered finance, creating markets where mathematical sophistication determines success and human intuition plays an increasingly minor role. We've traded the shouting pits of Wall Street for the silent hum of server farms, proving that in modern finance, the most valuable currency isn't dollars, it's mathematical insight.